The tragedy of every major economic transition isn't the loss of wealth, it's that people never saw it coming, even when it was right in front of them. Today, I want to talk about something uncomfortable, something almost no one wants to hear, but everyone needs to. 99.9% of people will lose their gold and silver, not because they didn't buy it, but because they didn't understand how the system really works. The truth is, history doesn't repeat itself perfectly, but it rhymes with remarkable precision. The deeper you study economic history, the more you realize that patterns, behaviors, and consequences follow a cycle. These aren't coincidences. They are baked into the human condition, driven by fear, greed, power, and the illusion of control. Yet, despite the overwhelming evidence, most people forget. They get caught up in the moment, believing that the present is somehow fundamentally different from the past. That mistake is what separates those who build lasting wealth from those who lose everything when the cycle turns. The cycle starts with optimism. Economies grow, credit expands, asset prices rise, and people begin to feel safe. Confidence turns into overconfidence, and that overconfidence leads to complacency. People stop asking hard questions. They stop managing risk. They start to assume that the current trend will continue indefinitely. But that's never how it works. The debt grows. The imbalances build. And beneath the surface, the cracks begin to form. Eventually, something gives. Interest rates rise, liquidity dries up, a shock hits the system. That's when the correction comes. The same people who once felt secure now feel fear. The same investors who were chasing returns now rush for safety. Panic sets in, and prices collapse. Then everyone says no one saw it coming. But many did see it coming. They just weren't the loudest voices in the room. Most people weren't listening because the truth is uncomfortable. It disrupts the narrative that everything is fine and will always be fine. And the more people ignore the cycle, the more severe the correction tends to be. If you zoom out, you'll see these patterns over centuries. The Dutch tulip bubble, the South Sea bubble, the roaring 20s and the crash of 29, Bretton Woods, the stagflation of the 70s, the dot-com crash, the 2008 global financial crisis, and the ongoing distortions created by unprecedented monetary and fiscal interventions in recent years. Each event is different in its details, but structurally they are similar. Human nature doesn't change. Only the tools and technology evolve. Cycles are not accidents. They are the consequence of predictable behavior. Expansion leads to excess. Excess leads to fragility. Fragility leads to correction. Correction resets the system, and the process begins again. The real tragedy isn't that the cycle turns. It's that most people are completely unprepared when it does. They've been taught to think in straight lines. They believe that prices go up forever, that governments will always have control, that central banks can fix any problem, but systems, especially economic systems, don't work that way. They operate more like ecosystems. They self-correct, and when the imbalance is too great, the correction is not gentle. It's abrupt, it's painful, and it's often necessary. Those who thrive over the long term are not the ones chasing returns at the top of the cycle. They are the ones who remain grounded, who understand history, who know that risk is not about probability, it's about consequence. They diversify, they build resilience into their portfolios and their thinking, and they prepare for what most people ignore, the inevitable turning of the cycle. This doesn't mean living in fear. It means living with awareness. It means knowing that the greatest opportunities come not during the boom, but in the aftermath of the bust. If you've positioned yourself correctly, it means understanding that wealth is not built during easy times. It's preserved by anticipating the hard times. The same people who say this time is different are usually the ones who get caught off guard. They forget that every period of irrational exuberance has ended the same way. They forget that every major collapse was preceded by warnings that were dismissed. They forget that stability breeds instability, that success sows the seeds of failure, that every high carries the weight of a future low. Understanding the cycle is not about predicting the exact moment it will turn. It's about knowing that it will turn. That's enough. Because when it does, those who prepared won't just survive, they'll be in a position to thrive, not because they were smarter, but because they remembered what most people forget. The cycle always repeats. And those who fail to respect that truth are always the ones who pay the price. In times of economic certainty, people tend to trust paper. It feels convenient, efficient, safe. There's a belief that a printed document or a digital number on a screen represents real wealth. But history, when studied carefully, tells a very different story. When things fall apart, when systems come under stress, those paper promises often vanish. What remains is not the paper. It's the real asset behind it, if it exists at all. And that's where most people make a critical mistake. They confuse claims on wealth with actual wealth itself. A promise is only as good as the entity making it. A government, a corporation, a financial institution. They can all issue notes, contracts, certificates, shares, but none of those things are wealth in and of themselves. They are representations. They are IOUs, and IOUs become worthless the moment the issuer can't or won't fulfill the promise. That's not theoretical. It has happened countless times across countries, across centuries. Gold, silver, land, productive businesses. These are real things, tangible, limited in supply, not dependent on the health of any one institution. They don't require someone else's solvency to hold value. They exist independently of the promises people make. And during times of uncertainty, real things rise in importance while paper promises are revealed for what they truly are, a bet on stability. When markets are booming, when liquidity is easy and interest rates are low, people forget this distinction. They buy into ETFs that claim to be backed by physical metals, but never read the fine print. They hold unallocated accounts, trusting that their assets are somewhere in the system. They invest in derivatives, synthetic contracts, and leverage-driven financial products, believing they are diversified. But in reality, they are exposed to multiple layers of counterparty risk, most of which they do not understand. The truth is, in times of extreme volatility, people often learn the hard way that their gold isn't really gold. It's a line item. It's a claim. And when redemption is needed most, access is either delayed, restricted, or denied altogether. The structure of the financial system is not designed to honor all paper claims in a crisis. It simply can't. The illusion only works when confidence is high. Once trust breaks, everything that relied on it begins to collapse. This is particularly relevant in the precious metal space. For every ounce of physical gold that exists, there are multiple paper claims issued against it. In a rush for liquidity or safety, only those with direct possession or clearly allocated legal title will come out whole. The rest will be holding paper, waiting in line, watching time work against them. This doesn't mean that all paper instruments are bad. In stable environments, they can serve useful purposes, but they are tools, not substitutes for the real thing. And relying on them without understanding their underlying risks is dangerous, particularly at a time when debt is at historic highs, geopolitical tensions are rising, and trust in institutions is declining. We've seen this movie before. In 2008, major financial firms failed overnight, freezing access to funds. In past sovereign defaults, people woke up to find that their accounts had been restructured, their savings devalued, or their assets seized. And in some countries today, capital controls, currency restrictions, and asset freezes are becoming normalized. Paper didn't protect anyone in those moments. Real assets did. The lesson is simple, but often ignored. If you cannot touch it, secure it, and independently verify it, then it is not truly yours. It may be convenient, but convenience has a cost. And that cost becomes visible when the system buckles. Real assets don't promise. They are. In the end, the fundamental distinction comes down to this: ownership versus claim. One gives you control. The other gives you hope. And when the next economic stress arrives, hope won't be enough. Only real, tangible, controlled assets will matter. Because the world doesn't run on promises when it's under pressure. It runs on what's real. When it comes to markets, economics, and wealth, the biggest risk isn't external, it's internal. It's not inflation, interest rates, or geopolitics that determine most outcomes. It's human behavior, the inability to manage fear, the tendency to follow the crowd, the emotional highs of optimism and the devastating lows of panic. These are the forces that destroy more wealth than any crash ever could. It's not that people don't know what to do. It's that when the pressure builds, they can't bring themselves to do it. The crowd is a powerful thing. It creates a sense of safety. Most people are hardwired to seek consensus. When everyone is doing the same thing, it feels right, even if it's dangerously wrong. This is how bubbles form. This is how panics begin. And this is why, over and over again, you see the same behavior. People buy when things feel good and sell when things feel bad. But the market doesn't reward feelings. It punishes the undisciplined. During periods of prosperity, the herd becomes euphoric. Assets rise in value. People convince themselves that this time is different. Valuations don't matter. Risks are ignored, and basic fundamentals are replaced with narratives. Anyone who questions the optimism is dismissed as negative or out of touch. But what's actually happening is simple. The further markets stretch away from reality, the more vulnerable they become to a sharp reversal. And when that reversal begins, the psychology shifts instantly. Fear spreads faster than logic. One piece of bad news becomes a catalyst. Selling begins. Not because of sound analysis, but because of emotion. People see prices falling and assume something is wrong. They don't understand what's happening. They only know that others are getting out, so they follow. Not based on information, but instinct. And that's when damage compounds. This psychological loop has played out for centuries. It's the same mechanism behind the South Sea bubble, the Great Depression, the dot-com collapse, and the 2008 financial crisis. What's astonishing is not that it happens, but that people still act surprised when it does. They look back and say it was so obvious, yet when they're in the moment, they can't see it because they're caught inside the crowd. They're reacting, not thinking. Gold and silver are perfect examples of this behavior. When prices are rising, people flood in, not because they understand the fundamentals, but because they see others doing it. They don't ask why. They just want in. And the higher the price goes, the more confident they become until it turns. Then the psychology flips. A dip becomes a drop. A drop becomes a crash. And suddenly, the very same people who were bullish at the top are panic selling at the bottom. Why? Because they never owned the asset with conviction. They owned it with emotion. Their decisions were driven by headlines, sentiment, and price action, not principle, not logic. That's why 99% of people lose money in cycles, not because the asset was wrong, but because their behavior was to build lasting wealth. You need to step away from the herd. You need to think independently. That doesn't mean being contrarian for the sake of it. It means developing your own understanding of value, cycles, and risk, and making decisions based on that framework, not the mood of the moment. Discipline is what separates success from failure in investing. It's the ability to remain calm when others are panicking, to buy when things are undervalued and unloved, to sell or hold when the crowd is greedy. It requires a mindset that is rooted in long-term thinking, not short-term emotion. And that mindset is rare. Most people are not emotionally prepared for the volatility that comes with real investing. They want safety and upside, comfort and returns. But markets don't offer that. They offer uncertainty, stress, and opportunity, usually all at once. If you can't manage your emotions, the market will manage them for you, and the result will not be in your favor. The key is to recognize that psychology is not just a factor, it's the dominant force. Understanding the fundamentals is necessary, but mastering your behavior is essential. Because in every cycle, there's a moment where things don't make sense. Prices move against logic. The news gets worse. Fear peaks, and the herd runs for the exits. That's the moment that defines your outcome. If you can stay grounded while others are losing their way, you won't just survive the cycle. You'll come out stronger. Not because you outsmarted the market, but because you outlasted the panic. Throughout history, when nations have faced deep economic stress, when debt burdens became unmanageable, currencies lost trust and systems began to unravel, governments have done what they always do. They prioritized their own survival. And in doing so, they reached for whatever tools were available to them. One of the most direct tools has always been the assets of the people, especially gold, especially silver, especially anything that represents value outside of the state's control. Confiscation doesn't always come with loud announcements. It doesn't always look like men breaking down doors. Sometimes it arrives through policy, through legal orders, through emergency acts. It's justified as necessary, temporary, or patriotic, but the result is always the same. Wealth that people believed was theirs becomes property of the state. This isn't a theory, it's a historical pattern. In 1933, at the height of the Great Depression, the U.S. government issued Executive Order 60-02. It became illegal for American citizens to own most forms of gold. They were required by law to turn their gold into the Federal Reserve at a fixed price. Failure to comply meant fines, even imprisonment. The reason? To stabilize the monetary system, to give the government control over gold so it could expand the money supply. The people who turned in their gold watched just a year later as the government revalued gold upward, effectively devaluing the dollar and enriching itself at the public's expense. That's not a rare event. That's a model. And it's one that repeats under pressure. When governments accumulate massive debts, when they print money to cover deficits, and inflation begins to accelerate, they eventually reach a point where conventional policy tools stop working. That's when they turn inward. Capital controls are imposed, bank withdrawals are limited, gold and silver ownership is targeted. Sometimes directly, sometimes indirectly through taxes, restrictions, or surveillance. People often believe that things are different now, that they're more sophisticated, that modern democracies wouldn't resort to such measures. But that belief ignores the fundamental reality. When a system is at risk, the rules change. Laws are rewritten, rights are suspended, and history shows that public trust is one of the first things sacrificed to maintain institutional control. In recent decades, we've seen governments freeze bank accounts, restrict access to cash, outlaw currency conversions, and tighten reporting requirements on precious metals. The mechanisms evolve, but the intent is the same: control capital, prevent flight, maintain the illusion of stability. The key mistake most people make is assuming that ownership means security, that if they hold gold or silver, they're protected. But the critical distinction is how they hold it. Assets stored in the financial system in banks' vaults under corporate custody or tied to digital records are visible, accessible, trackable, and ultimately vulnerable. When pressure rises, those assets can be locked, taxed, or seized with a single legislative act. True protection requires layers: legal, physical, and strategic. It means thinking several steps ahead. Where is the asset held? Who can claim it? What jurisdiction applies? Can it be moved, hidden, defended? These questions aren't hypothetical, they are practical. And in environments where trust erodes and power centralizes, they become essential. Most people don't ask those questions. They operate under the assumption that if something hasn't happened in their lifetime, it won't happen at all. But history isn't just about what has happened, it's about what tends to happen under certain conditions. And the conditions we are moving toward: rising debt, declining real growth, social unrest, geopolitical tension, are precisely the ones that have led to state overreach time and time again. The irony is that gold and silver are often held as protection against systemic collapse. But without understanding the political risks, they can become liabilities instead of safeguards. Because in times of crisis, what governments can't print, they try to control. What they can't inflate, they try to regulate. And what they can't regulate, they may attempt to remove. The lesson isn't paranoia, it's preparation. It's recognizing that ownership isn't binary. It's not simply a question of, do you have it? It's, can you keep it when it matters most? Because when the system is stretched thin and governments are forced to choose between collapse and confiscation, history shows us which path they take, and it's never the one that favors the unprepared. Most people spend their lives trying to accumulate wealth, earning, saving, investing, growing their net worth, but very few think deeply about preserving that wealth. They measure success by what they acquire, not by what they're able to hold on to when things change. And things always change. The reality is, wealth isn't just what you own, it's what you keep. And keeping it, especially through periods of instability, requires a level of understanding, preparation, and discipline that most people never develop. In times of expansion, it's easy to feel successful. Markets are rising, credit is flowing, confidence is high. Even poor decisions get masked by upward momentum. People think they're making smart choices, when in fact they're just riding a favorable cycle. But cycles don't last, they turn, and when they do, the true nature of your financial foundation gets revealed. Not in theory, but in practice. This is when the difference between having wealth and keeping wealth becomes stark. Owning assets is not enough. If your wealth is tied to inflated markets, over-leveraged institutions, or unstable currencies, it can disappear faster than you think. If it's dependent on a fragile legal structure or on the assumption that governments will always protect your interests, you're exposed. You may own gold, stocks, property, or even cash, but ownership doesn't equal security. What matters is resilience. Resilience is built by understanding risk, not just return. It's about asking, what could go wrong? What am I exposed to? Who really controls this asset? What happens in a crisis? Most people don't ask those questions. They focus on accumulation. They chase the next opportunity. They put their faith in systems they don't understand, and they ignore the historical truth that wealth often evaporates, not because of bad investments, but because of bad assumptions. Inflation is a perfect example. It silently erodes the value of money over time. People think they're saving, but they're losing purchasing power. Taxes do the same. regulations can shift, property rights can be altered, entire currencies can be restructured. These aren't speculative risks. They've happened again and again across regions and time periods. If your wealth is not structured to withstand those kinds of changes, you haven't really protected it. You've just parked it, hoping nothing goes wrong. Hope is not a strategy. There's also the question of psychology. People overestimate their ability to stay rational under stress. They say they'll hold through a crash. They say they're long-term investors. But when panic sets in, they follow the crowd. They sell at the bottom. They make emotional decisions, and emotional decisions destroy wealth faster than any market downturn. Keeping wealth requires clarity of mind. It requires detachment from hype and fear. It means knowing why you own what you own and under what conditions you'll act. It means having a framework, not just a portfolio. It also means understanding the role of real assets, things that don't rely on someone else's promise. Gold, land, productive businesses assets with intrinsic value and limited counterparty risk. These tend to hold up when the financial system weakens. But even then, it's not just about owning them. It's about securing them, holding them in the right jurisdiction, under the right structure, in a way that can't be easily undermined or confiscated. Because when the system is under stress, rules change, taxes rise, restrictions tighten, doors close. And if you haven't planned for that moment in advance, it's already too late. True wealth preservation is quiet. It's not flashy. It doesn't chase the news cycle. It operates with a long view. It looks past temporary gains to ask, what will still matter when the dust settles? What will I still control if the rules shift? What will I still own? Not just on paper, but in reality. The goal isn't just to grow wealth. It's to protect it, to pass it on, to use it as a foundation for opportunity, not as a fragile bet on stability. That's the difference between owning wealth and keeping it. And in the end, when the cycle turns, as it always does, the people who kept their wealth will be the ones best positioned to build again. Not because they took the biggest risks, but because they respected the risks that others ignored. Wealth isn't measured by what you accumulate during calm times. It's measured by what you preserve through chaos. If you don't understand your goal, you don't own it. If you haven't fought through the cycles, the history, and the system, you're not safe. This isn't fear. It's a wake-up call. Because in the end, only a few understand how wealth survives. And the rest, they become the story history forgets.